Hey everybody, this is Jose Blasco. We are about to get started in just a moment. I just wanted to confirm sound is good. If we could have a quick sound check, that would be great. That is done by just sending a quick hello message on the chat box. So I know that you hear me. And on top of that, it's a nice thing to do, to say hello, isn't it? So please go ahead and do that. So we can start in 36 seconds. So I know all is good with the sound. Thank you so much, guys. Very good. Still got 20 plus seconds to go, so we'll just wait that time. And happy to get started in just a few moments. Looking forward to it, actually. Thank you so much, Joe. This is very nice. Very nice. Perfect. That's it. So we are hitting the top of the hour. Welcome, everybody. The session is now officially started. This is Options with Options. My name is Jose Blasco. How are you, Jeff? Good to see you as well. This is February 23rd, 2022, and we are getting together today to talk about options. Of course, the name of the session, I guess, says it clearly. Before we get started, I will highlight the disclaimer. Please read it carefully. This is important information. How are you, Mark? It's good to see you, my friend. It's good to see you all, guys. And as the disclaimer completes its highlight, we are now ready to talk about the agenda for the session, where we normally look at the market environment. From there, we look at trades that we have. We talk about trade management. And from there, we move into looking for new trading opportunities. Here we go. So again, the session is now officially introduced. And my last comment here before we jump into the charts, it's basically highlighting the link to the questions page. In my case, it would be tradewithufos.com/Jose. If you are Becky, it would be Becky /Becky. If you are Josip Boyan, you got it, /Becky /Boyan /Josip, etc. This is how you get to the specific page of your instructor, and there you can go ahead and ask questions. I always recommend to look and search for questions because the answers may be there waiting for you. If not, feel free to post your questions there and you will get your answers. Cool. So ready to begin with our market analysis. Okay, ready to begin with our market analysis. Let me see 1 second here. Oh no, actually I had the right symbol. I just wanted to expand this a little bit. Okay, so we have a little bit of a better visibility. Here we go. So the chart that we are looking at the moment is the chart of the S&P 500 ETF. It's SPY, as you can see on the screen. And we started since 3 days ago a down climate. We are in this down climate for 3 candles. Statistics suggest that a normal duration for down climate would be of 2. So we are reaching the statistical end of the climate. Again, it's important to understand what I mean when I say statistical end. Statistical end means that that based on statistics, the climate should end. Of course, there are many forces driving what happens in the marketplace. I'm sure we're all thinking about what's happening in Ukraine and Russia. Obviously, those are situations and forces out there that may reverse or contradict the best statistical analysis of whatever market. Next thing you know, the complete opposite happened because there is this humongous event happening that changes the whole sentiment in the market. All the orders got canceled, new orders get added. So again, these things could happen. But while these things could happen, more often than not, and that's the power of statistics, statistics tend to be met. In this case, we are now surpassing a 1 standard deviation of the cases. How you, Christian? And therefore, from a duration point of view, this down climate should soon revert and go back to blue. And from there, we will be able to see, or we should be able to see, a progression to the upside back into a blue climate of 6 candles of duration. Okay. Now, in the current times, okay, and this has a lot to do with, again, geopolitical events and what's happening in the world, basically. We had the new wave of Omicron pandemic in many countries a few months ago. Then the threat with Ukraine, all of those things, and you can see some of the impact here, where we got a blue climate here that was kind of normal. Here the red climate was exaggerated. It was more than 2-3 candles. Here the blue climate was a little less long, lots of indecision. Then back to a normal blue climate, and then a longer red climate, and then a longer red climate, and a lot of indecision right here. And now again a climate which is slightly on the long side. The prior red climate was 4 candles, now it's 3. So slightly on the longer duration side, but you can see how it's been a while that we have not seen the market to go from red to blue and get long duration blue, like for example a few months back. So all of this may imply that we may start seeing changes on those statistics. Even when looking at other time frames, for example weekly, we are now even in that time frame, the climate to the downside is very exaggerated. Okay, 6 out of what statistics would suggest is 2. But on the other hand, while it's exaggerated from a duration point of view, from a price movement point of view, it's not that bad. I mean, it could get way worse when it comes to speed of movement, since the max distance on a weekly time frame is telling us that 2.17 is the definition of too far too fast. And so far, the most we've got here in the last climate is 1.5. So we could still have a long bar coming up here on the weekly time frame before we can really start seeing a proper reversal, a new weekly blue climate, which would lead to many blue climates on the daily time frame as well. But again, this is not happening yet. Okay, so we gotta act cautiously because we have lots of contradictory information since multiple weeks, plenty of contradictory information. For example, right here, we just said the climate has surpassed 3 is more than 2, so we are in the less likely territory for the climate. But at the same time, when you look at the implied volatility for the puts and the implied volatility for the calls, then you can see that the implied volatility for the puts, which is the gray line, is greater than the blue. So there is a bearish component clearly coming in from the derivative markets, and this is likely going to make this climate to last more than what statistics would suggest. So from that angle, okay, we don't have a contradiction. Actually, we have kind of like a confirmation that the climate is going to continue. But having said that, here's the contradiction. Max distance is 107. We are currently at 121. So from a max distance point of view, statistics suggest that on the daily time frame, this is moving too far too fast, and therefore entering the territory of non-sustainable. So this huge amount of put buying coming from the options markets, maybe just hedging, fear kicking in, whatever it is, again, it may not be sustainable. That's my point. And because it may not be sustainable, but is red, it's too soon to bet hard on trades betting on bullish moves, and it's too late to bet heavily on trades betting on bearish moves. It's almost like Murphy's Law. I mean, this is happening like for 2 or 3 weeks in a row, where when we meet on the Wednesday or the Thursday, the market is giving us those contradictory pieces of information, which, by the way, this happens often. It's not like it happens only when we meet. But, again, I appreciate if the market was kind to us as well to give us like clear, defined market conditions so we can bet a bit more aggressively on the type of trades that we plan. But that's what we have today. So with that type of market environment, again, non-directional type of trading, it's the best approach. Because if you get directional, you need to do a lot of hedging to counteract possible moves against you, given the contradictory signs that we just analyzed. Now, if we look at the current levels of implied volatility, as of now, we are dealing with a VIX of 30.70, which is a pretty interesting, hefty level of premium. With that type of level of premium, we can certainly look and hopefully find good quality trades when it comes to non-directional trades in the form of iron condors, which would benefit very well of price doing whatever it has to do within a very wide range, while those options decay, those options shrink as the implied volatility reverts back to a lower value, because right now the VIX is quite high. Okay, the VIX is quite high. Can it go higher? Of course, it can go higher. If the market was to really fall, if something very bad happens in Ukraine, you can see the VIX go from 30 to 50, 70. Like that's the thing about the VIX. When it goes up and there is a reason behind it, the speed of movement to the upside of the VIX is really humongous. Okay. But in any case, if we find price ranges where this level of volatility provides premium enough to provide us with a trade which meets our rules, we'll be more than happy to take it. And that's going to be the type of trades that I'm going to be planning later in the session as I complete the review. Okay, so this is kind of all I've got when it comes to market analysis. One look at the volume map. I didn't do it, but again, it's the same thing. So the volume map is showing. One moment here. Yes, daily time frame. So the volume map is showing implied volatility of the puts greater than implied volatility of the calls. This is real time. On the left, you see the number 3 means 3 the average. This is real time, no number, so this is real time. So not only in the last 3 days as an average, the puts are winning. Today, the puts are winning, and we got 2.4 times more puts traded than calls, 4 times more puts traded than calls, 5.9 times more puts traded than calls. Again, huge bearish component, while the climate is supposed to reach his statistical end from a duration and max distance point of view. So what a contradiction. Again, one more time, we're going to be dealing with non-directional trades. Okay, that's the plan. Any question, go ahead. And before I start reviewing the trades and putting trades together, so any question, feel free to interact anytime. For the ones of you that are part of the sessions in a regular basis, you know that. For the ones of you who are newer to the sessions or watching this recorded, feel free to use the question page or feel free to interact. Don't be shy, please. Christian, lower low on the daily EMA on the spider. Yes. I mean, price movement is pretty clear, right? Even if you get into candlestick analysis, so the prior candle was an indecision candle, doji type of candle, if you wish. Next thing you know, the next candle is like an engulfing candle to the downside. So it's kind of like not only erasing the prior price movement that was kind of indecision, is actually erasing it and making it very clear that, hey, I'm going down. Now, of course, you technically you should not read this candle until the close of the day, which is going to happen a few hours from now. So next thing you know, you may have a blue candle at the end of the day because now a lot of buying kicks in. Could be two. Anything could happen, really, especially at a time where everybody's looking into those geopolitical events. Okay, but again, we are systematic traders, right? So we just follow on our rules, our plan, instead of now trying to guess what's going to happen if something happens. And when it happens and why it happens, and that this is not an efficient way on how to trade, isn't it? Cool. So trade review. So I'm going to look at positions. We got FedEx. Okay, FedEx is an iron condor, and I am delighted that we're going to be working with the FedEx iron condor because this trade has reached, at least a few minutes ago, yesterday as well, perfect. I mean, like, it's perfect. I'm so happy we're meeting right now because this trade is now reaching its time for us to move in damage control mode. Okay, damage control mode. So what is damage control mode? Well, damage control mode is, again, for the ones of you that may have missed a few sessions. So, there was a time a few days ago where that stock was trading happily within the purple area. Statistics represented by the cone that we have, which are the red line and the blue lines, were suggesting that price would go as high as here or as low as here, meaning that we would not reach any of the purple lines, and therefore the trade should end up pretty okay. And the profit zone is the purple zone. I mean, outside the purple zone right there, you would lose. Okay, but again, we also know that in that zone, we have UFOs, right? And the expectation is that if price comes in here, you are going to experience either a very strong slowdown effect or a bounce back into the purple zone. That's the expectation, which, by the way, in this case, didn't happen at all. The sign of those orders being canceled, okay, which is in line with a very bearish sentiment in the market. But in any case, that's the expectation, right? So at that time, happy day, no concerns, all is good. But then the next day, right? The next day, the market really pushed hard, okay, and we talked about it last week. We crossed, okay, on our expiration date. the red line was below the purple line. Okay, so at that time, it's time to begin with the tweaks. And the tweaks, just as a little review from last week, were about taking the calls that were somewhere in this region of the chart and bring them down towards this area in the chart, which is where the new red line was, more or less, okay, right here. And then we found some UFOs about that red line, and therefore this allows us to draw a new purple line, and therefore we are using the calls related to this purple line, bring them down to the new purple line, which is related to the new location of the cone, given the fact that we are now for the first time breaking the below purple line with a cone, suggesting that statistically speaking, we may end up losing, okay, statistically speaking. So since that day, we were supposed to be rolling the calls down, then the market, kind of paused a bit, came back down, okay, paused a bit. Wait a moment. Why is my cone not moving with price? Maybe edit study, probability cone. Okay, yes, I did. I guess I dragged it and it was not following. So anyway, so now what happens is that, as the market was going down, so every time you had an opportunity to draw a new red line, find new UFOs somewhere in here, and then find and draw another. I'm just gonna make it red, but let's pretend this line is purple. Have another purple line there, and therefore one more time, not only you had calls on the upper side that then they were brought down to this side, this high. Now those calls that were tweaked, now they should be brought back down here. Okay, so again, we were not in the sessions together when the market was going down these last few days, so obviously I have not been able to do all of those tweaks. But I guess, the other day I planned for one of the tweaks, and the additional tweaks as the market kept going higher, kept going lower, is the same story. But now when we fast forward to yesterday, or most interestingly today, right here, okay, so what's the situation now? Well, now it's not about the cone is surpassing the purple line, which it did a few days ago already. What's surpassing the purple line now is the price itself, is the bar, is the candle itself. And this is now giving us the greatest level of alarm when it comes to moving into the most aggressive damage control mode we can, which is converting the iron condor all the way into an iron butterfly. Okay, so I'm just giving you a little bit of a summary of the story. Please, if I'm giving you too much information because you know it well already, tell me to keep going. If you need me to repeat, let me know. If it was good, let me know as well. I always appreciate the goods and the no goods as well, but better than silence. Any comment helps a lot on my end, okay? So anyway, so an iron condor, right, which was the initial trade, is something made of calls on the upper side and puts on the bottom side. That's an iron condor. So again, those tweaks I was talking about, which should have been done once per day as the market was going down, and the cone kept moving lower, pushing the upper red line lower as well. So assuming that you could do those tweaks every day or like every 2 days or whatever, because it also depends on where the UFOs are and the strike prices available on the option chain. So basically those tweaks would look something like that, right? So you had those upper calls, you move them down, then time to tweak again. So the second set of calls you used, you move them down again, right? So it would look like that. And now finally you get to a point where the thing drops so much that what you're gonna do now is you're gonna be doing the same, rolling the calls down again. But now what's gonna happen is that the strike for the put and the strike for the call are gonna be exactly the same. And therefore, the structure you're gonna be left with is what is known as an iron butterfly. That's what you now get, okay? So it's like an iron condor, but where the call and the puts that you sold are in the same place, the same strike, instead of being apart, because remember, the initial call was sold way higher. The initial put was sold way lower. Well, now we are selling the call where the put is, okay? So let's go ahead and look at what's the resulting effect of doing this, okay? Because obviously there are multiple factors that may help or hurt. Of course, everything starts with knowing what is it that we got. In my case, I got FedEx here, which is the original Condor. Okay, this is the original Condor. So right now the P&L of this trade is minus 360. If you did nothing, the maximum risk is 395. So that's the most you can lose. We are currently trading at 216.65. This is the current P&L. If the stock was to be trading at this price point, and this was March 4 expiration date, so then you would lose the full 395. Okay, so we are now with a negative P&L of 365 as we speak. Okay, so again, if you had done multiple of those tweaks, okay, which again, if I show you my Thinkorswim demo account here, so with FedEx, I just got the original set of options. Okay, and it's many trades every week, so I don't remember everything. But if I'm not mistaken, the one thing that we concluded last week when I was trying to tweak it is that we were not getting enough premium. The strikes were not liquid enough. Something like that was happening. The spread was wider, and it was not really helping to do the tweak. Okay, but again, if you keep persisting, if you look at this every day, there is a moment in time where normally, okay, and of course it depends on the liquidity of each instrument. Every stock in the market is different, but normally you end up finding the way to do the rolls, and that brings in premium. So what happens if you bring in premium? Just for everybody to have this very clear, okay, I'm just gonna emulate. I'm just gonna pretend, okay, that the call side, which is the 285 and the 280, okay, the 285 you bought and the 280 you sold. So I'm just gonna pretend that you bought the 285. So let's say you sold it, okay, and the 280 that you sold, you bought it back. Okay, so let's pretend that's the case. So the 285 that you sold, you bought it back. Sorry, let me rephrase that. The 285 that you bought, you sold it. Okay, so you bought it at 0.73. Let's pretend we got filled at 0.25. I'm just making this up for you to see the effect. Okay. Not sure why it changed my strike here. So 285. Okay, so 285, 285. Okay, you bought it at 73, you sold it at 25, so you lost money on that. And then the 280, you sold it at 113. The 280 sold it at 113, and let's say you bought it back at 0.35, for example, a little more. Okay, so if you did that, so you would be left with the orange graph. Okay, which is basically the same as the blue graph on the bottom bar, but of course now, because you only have the put side and you don't have the call side, if the stock was to go up, it doesn't matter how high it goes, on the upper side you profit. Okay, and why? Because again, you only have put, you don't have calls at that time. What I have emulated here is that you took the original calls to 85 to 80 and you got rid of them. Okay, now rolling the calls down means that now you go ahead and you do it again. So buy and sell. You do it again at a lower strike. Okay, and I'm going to do mid. So instead of 280, let's say you did it at 230, for example. So if you did 235 to 30, for example. Okay, if you did 235 to 30, again, I'm not sure how much premium is going to be there, but in this case, it seems that you would collect 66 from one of the option, you would pay 31 from the other option. So that's a credit of 30 cents additional that you collected in. Okay, and what's the net result of that? Let me see, guys. This is not making sense to me. So you are buying the 235 call, you are selling the 230 call. Why is giving me a flat line? That makes no sense. I must be doing something wrong there. Let me see. I must be doing something wrong. I am not fully sure what is it that I have done wrong, but I have done something wrong here. So anyway, um, look, I don't want to spend too much time here. I just want to get into the trade, but I just wanted to kind of review the context so it's understood for when you have to do this by yourself. Okay. So anyway, so the point is, if I had done this correctly, okay, which I'm going to delete. So what would happen is that this max risk, which is right here, that will go higher. Now the max risk would be the same risk you had before, 395, but diminished by the new credit collected, which is 30. So now you will have 365. So you would have less risk. Also, because you have more credit, if you're right, you're going to make a little bit more of a profit. So instead of that profit, if the stock was to bounce and go back higher, you will make a bit more. Okay. But also because you're selling calls that are a bit closer, so then your upper break-even point, it's going to be penalized a little bit. Instead of such a high break-even point, your break-even point is going to go down by a little bit, which is not that big as a problem because you are doing that based on the probability cone. So you should still end up in the green area, assuming the stock bounces back. If the stock doesn't bounce back, of course, this is a non-directional trade. If it keeps falling, forget about it. It's the worst case scenario, which is what's happening, which is why I'm excited to work on the trade so you get to see it. Okay. So anyway, so if you did that, let's say you did that 2 or 3 times and you collected, 30 cents each time, okay, which must have been difficult to do based on what I saw last week when it comes to the levels of liquidity. But if you kept persisting and you kept trying, I'm pretty positive at least a couple of times you may have been able to get 30 cents. So 2 times 30 cents, that's 60 cents, that's $60 less of risk. So right now you will be sitting on a trade which is, $300 something of risk, $300 something of risk instead of almost 400. Okay, so that's the little benefit you achieved. But again, that little benefit, you are happy to achieve it because remember, going back to the chart, what we expect when price comes into the zone between the red line and the purple zone is that the green UFOs available there from the 55-minute time frame, they turn the price back up, but it didn't happen. Okay, so you are in order to give yourself the opportunity to have price go back up, you are willing to limit the risk by a little bit in exchange for price to come back up. Okay, but now we are being proven that price is not coming back. Those UFOs are gone. Okay, the on-field orders have been canceled. That's why price kept going down. If the on-field orders were humongous and they got filled, price would go higher. It didn't, which means many on-field orders got canceled. And therefore, we are now proven that this ranging stock that we analyzed with the matrix, with the strength tools, looking at the strength on the daily, looking at the strength on the weekly, that was a stock with no strength. That was the whole point. It was a stock with no strength. Well, guess what? That stock now is showing strength and is to the downside. And therefore, we are now proven wrong on our expectation for the stock to move sideways. So what should we do? Well, option number one is exit the trade right now, and you collect $355 of risk instead of $395. But I don't feel this is a smart choice because then you are just accepting your loss, which is okay. But again, given the fact that from 355 to 395, there is not much more as a difference, right? And even less if you have been rolling. So, I rather let the stock do what it has to do because there are more UFOs on the chart, okay? And you never know, it may come here and then bounces. And on March 4, we're back in the purple area and we make a profit. We've seen this happen before, isn't it? So closing the trade now, while it's a valid choice, nothing wrong, but to me is not the most optimal choice. At the same time, this is not a time for me now to keep rolling the bear call down, hoping it's going to come back, and collect just very little credit each time. This is the time for me to move in that mindset where it's full damage control mode. Why? Because I have been proven wrong all the way to the purple line. I cannot get more evidence than that. This is not a non-directional movement anymore. This is indeed a directional move, aggressive one to the downside, impulsing, I am totally wrong on my expectation for price movement. I need to be very aggressive with my damage control definition. And how can you get the greatest amount of premium? Well, the greatest amount of premium you can get is by selling options the nearest to price as possible. Okay? And what's the nearest as possible? Well, the nearest as possible is where the price is now. So we're going to have two different analyses of our butterfly evolution. So we are using 230, 235 puts. Okay, that's what we have on the chart. Okay, so if I was to type it, we are short, which is more or less here. 230 is more or less here. So we are short the 230 put, and we are long the 200. Sorry, we are the 235. Okay, 235 and the 230 put is what we have. Okay, so this is where those units are. They're here. Okay, so for me to butterfly it and just to do like a normal standard butterfly, okay, what I will want to do is I will want to, as I said, buy the 240 call and sell the 235 call. Okay? By doing that, okay, by doing that, I have a butterfly. Okay, that's what I wanted to have. So now I have a butterfly, and that's it. I'm good to go. Okay, yeah, I have my butterfly. Okay, but what is the price currently? 270. And what I did just say, what did I just say? What I just said is that normally the greatest amount of premium would be collected around the at the money strike, which is more around 220 to 15, okay, instead of 235. Now this is true, not always. Why? Because there is a skew effect, right? If I look at March 4, not all option strikes, okay, are the same. Okay, notice how the 217 got that level of premium, but the 235 seems to have 34% implied volatility versus the current one that has like 33% implied volatility. So, in one hand, you would expect the one which is the nearest to where the price is to have more, but at the same time, you can see how other strikes, for example, right there, 207, for example, up here, 235. So they have more implied volatility. Now, it doesn't mean your net result is going to be better, because for you to do the new selling of the calls, so you're going to sell this one here, which is sell the 235 call, but then you need to turn around and buy the next one, which is the 240, right? So you're going to buy the 240 call, and guess what? This one got way more implied volatility. So it may not work too well. Okay, it may not work too well. Where other cases, okay, there are other cases, okay, where you may have an opportunity maybe to sell the 207, and then you buy the 202, which are way lower than where the price is. And next thing you know, because that one got less implied volatility and that one got more, and you are selling this one. Actually, no, I'm saying this backwards. I'm saying it backwards. Sorry for that. So yes. Sorry, guys. For a moment, I was thinking put. Okay, we're doing call. So you may go ahead and sell this one. Okay, and then 207.5, and then you buy the 212, right? So you sell the 207.5 call, and then you buy the 212.5 call. You still got $10 of difference, but now you are supposed to benefit from a 38% volatility on the one you sell and only pay 35% volatility for the one you buy. So this may be a better choice. So in other words, when doing the butterfly, you would think the nearer to price is going to be the best, but it's worth it to move up and down a little bit, especially now that we know this about the 207 and and so on. So it's worth it to look at 2 or 3 different cases to see if any other combination provides a better advantage. Okay, of course, if you are doing 207 and 212, there is another impact here, which is the fact that those options are in the money. Okay, and because they're in the money, so there are other implications. When if you don't get a minimum amount of premium, now you are adding a greater loss. Okay, if you don't get a minimum amount of premium, so now you are adding a greater loss. Where if you do out of the money units like the ones on the right, so you are getting a premium, and if wrong, you will lose, but you will always lose less because being out of the money, that premium collected it's diminishing the risk. Okay, for sure. So again, pros and cons, and every option chain is different, and every skew is supposed to follow the shape of a volatility smile, as we can see. This is the theory, but notice how sometimes we got price anomalies, and those price anomalies may or may not work in our favor. Notice, now that I unfroze in the screen, notice how while the market is trading, those price anomalies also change real time. So again, you need to do a little bit of analysis before doing that to try to get the best damage control application as possible when something like that happens. Okay, and the goal of damage control, and again, let me rephrase that. I've said it in prior sessions, but it's very important. Okay, because it's very easy that when you are running this trade and the market is going against you and you start tweaking, it's very common, very normal, especially if you have not done this for too long. It's very normal that now trading emotions take control of you, and you start now feeling hope, right? It's a very human emotion that often we feel without knowing or realizing we feel it. So now, and that hope, what that hope is telling you is, it's going to come back to the purple area. I hope it's going to come back to the purple area. I hope in the end I'm going to be okay. And the reality is that when you move to damage control mode, the last thing you want to be thinking is hope. The one thing you will be thinking is very simple. It's two things. Number one is, priority number one, I want to reduce my risk. Because why do you move into damage control mode? It's because the trade is not behaving as according to plan. It started a few days ago when the cone pierced the purple line. So instead of hoping, please come back, you should be thinking, how do I reduce my risk? It's kind of like moving, instead of hoping mode, you move in skeptical mode. Okay, are you going to hurt me? Instead of, I hope you're going to be okay with me, right? I hope you're going to be good to me. So instead is, are you going to hurt me? Right? So you start moving into that mindset, okay? And when you get to this final stage of purple line, now the application is exactly the same. You're still thinking, how can I reduce my risk? But now you want to reduce the risk to the maximum as possible, and that's why we're going to go all the way to a butterfly instead of an iron condor. The other part of the mindset when you are doing this is, again, priority number one is, I want to reduce my risk. Goal number two is, I want to reduce my risk while I give the trade a second chance. If reducing your risk guarantees less of a loss, but guarantees a loss, okay, which depending on the strike selection could be the case, I'm going to simulate it and you will see. So you may end up, your $395 risk, you may drop this to, 110, right? And now you're like, okay, that's it. Now the most I can lose is 110. But then when you look at the risk profile, that's exactly what's going to happen. You will lose 110. Good news is less than 395, but bad news, if the stock was to rebound, there's no way you're going to profit because you went too far with your tweak. So we need to tweak in a way where priority number one is to reduce the risk, but priority number two is to still get some green somewhere in here. So if that market was to come back higher, maybe even not as high as the purple area, but as long as that market was to come back higher, you want to get back to a certain level of profitability, okay? So you give the trade a second chance, okay? That's the plan. So again, I'm super happy we're doing this together at this stage. I'm taking my time to do it because, this is very powerful. Again, it may or may not work in one trade, but you keep doing that throughout the year, and think about it. If a few of your trades during the year profited, a few of the trades during the year lost, but lost less than expected, and a few of your trades during the year that didn't work according to plan ended up profiting, even though they were not working according to your plan. So at the end of the year, you do the math, and it's pretty powerful stuff. So those tweaks those roles, those conversions that we do. I spend lots of time discussing it, guys, because this is the recipe to take your application of options trading to the next level. Instead of just getting to a trade and close your eyes and wait for the best, which this is another way on how to trade, by the way. But then you have to be right, 100% right in whatever your plan was. If your plan deviates, then you are not gonna hit those profits. Okay, so here the idea is to find this flexibility because the market, changes, and we can adapt to it thanks to those tweaks. Long conversation. This has happened before. Guys, I tend to explain and re-explain things. I guess as a good Spanish, I talk a lot. Maybe you're laughing now. I am indeed laughing. But again, I'm putting myself in your shoes now, getting a bit more serious. And I want to make sure you guys get not only the application, but also the mindset when doing this, when you do it by yourself. Okay, and when you're at home and it's you and your computer, and you get this under control. Okay, let me know how is it going, guys. If your comment is simply all good or whatever, I'm fine. If you have questions, please type them as I begin now doing the tweak. Okay, so to do the tweak, so the first thing we need to do is we need to emulate what happens if I close the calls. Okay, so I still have the 280, 285 calls. Okay, so I'm just gonna add 2 legs here to emulate what happens if I buy and sell. Okay, buy and sell, and the one I'm gonna buy is the 280, and the one I'm gonna sell is the 285, and I'm gonna do this at the midpoint, 280, 285. Following Christian, very good. Thank you so much for that. So buy back the 280 at whatever price it is now, sell the 285 at whatever price it is now, click OK. If I do that, I'm going to get like 3 cents, okay, between 2 and 3 cents. So I should be able to get filled on that. And now I would be left with the puts only, okay? So I am adding these 2 additional lines, notice using mid, to emulate what if I close my calls. And now that I close my calls, I'm going to emulate with a couple more lines. Thank you so much, Mark. This is very kind. I'm going to emulate what if I do the first one, which would be the natural one to do, which is the 240, 235. Okay. So what if I do the 240, 235, which is the natural one to do, okay, which again may work, may not work, may create very little premium like Jeff was suggesting. We're going to see that together. It has a lot to do with many things. It has to do with how far the price has moved away from that. It has to do with how much time you have to expiration. It has to do with, has price been falling very, very hard and volatility rise very much or not, or is there a skew, or is it a frown instead of a smile? Again, you never know. So just simulate and that's it. So buy the 240, sell the 235. And when we do that, so this would provide 32 cents and 21 cents, which is indeed very small. Okay. Now the effect, you can see it very clearly here, where now instead of 395, you would lose 384, which is the difference of 395 to 384 is the difference between 32 and 21, which is basically 11 cents, $11 less of risk, thanks to that. And good news though, we still have a zone that would allow for profitability. Okay. If the stock was to bounce back up, we may end up in that little tiny triangles, and that would be a profit. So if that's the only choice you have, so doing this versus doing nothing, it's a better choice. Having said that, reducing your risk by $11 only and end up with this such a tiny, tiny, thin triangle is not really helpful. Okay, it's not really helpful. So I need to keep exploring what are my choices. Okay, and what I'm going to do is just to keep moving down $5 at a time, because again, I could be looking at the volatility smile, at the skews, but this changes as we go. So I'm just going to simulate it, so I don't need to go back and forth between one window and another one. So what if we do 235 to 30. Oh yes, I now understand what happened before. Yes, if I do 235 to 30, I got the strikes wrong earlier. That was the problem. So if I do that, what I'm doing is basically I'm creating what is technically known as a box. And basically long put together with a short call with the same strike. Okay, that is equivalent to short stock. Long a short put together with a long call using the 235 strike, this is equivalent to a long stock. If you recall the sessions with Josip about synthetics, that's a synthetic long plus synthetic short. So that's why the P&L line, it's basically flat. And basically, thanks to the additional premium collected, you end up reducing the risk to 361. But that's it. Okay? 361 is your risk. And I will not do that because my orange line stays on the red zone all the time. There is no time where you got a little pop in the green zone, so you are not giving the trade a second chance. This is a trade where you are reducing the risk, but that's it. You are locking in a loss. Okay, that's what this trade is doing. So I'm not going to do this, and therefore I'm going to continue moving down and see what happens. We're going to move to 230 and 225. Okay, and it's not looking good. It's not going to work well, guys. Notice that if I do this, now I am collecting more premium. Okay, difference between 148 and 66 is a greater amount of premium. You can see how the risk now goes from 395 to 312 in that portion of the chart. But notice how there is a moment in the chart where you go all the way to $700+ of risk. And why is that? Is because those options are in the money. So being in the money, okay, being in the money, you need the net premium collected to be greater than a certain amount, which again, if you are lucky, and yes, I did say lucky, if you're lucky and you find those particular strikes where one of the options got so much more implied volatility than the other one, you got this price anomaly, as I said before. So next thing you know, you may get that, and now this is kind of like a reverse iron condor. Okay, it's like a reverse iron condor, and it will reduce the risk and still give you a very small window of profitability. It could happen. Okay, but it's a bit rare, of course. So we're gonna continue exploring to see if we find that setup. So selling to 25 and getting to 220. Okay, so notice this one is getting even more premium to 65 now. So now the risk drops to 235, okay, which is very nice. But again, worst case, we still have that portion on the chart that goes all the way to here, $700 of risk. So we are increasing risk. We are not coming back to the green area. So then, not looking too good. I'm going to do 2-3 more attempts to see if we pick some price anomaly that does the job. Okay, so if we do 220, 215, so again, we are cutting on the risk even more now. So 137 from 395. But notice how we still have this portion. Now it's about $600 of risk. So let's keep going lower a bit more and see if we can get what we need. 215, 210. So now we are more or less dealing with around the current price, okay, just slightly below. Okay, so now notice how the risk now is becoming $37 if you are, in an extreme position. But of course, if you end up in this portion of the chart, you will end up losing like 500 or something like that. So not too good. So I'm going to keep going down and see what if I do 210 and 205. Okay, so if we do this, now we are seeing some green, tiny green. Okay, if I put my mouse there, so you will make $12.50. So we are now seeing some green. I welcome that. But here, the bottom part, It's still below 400, so it's still below the blue line, okay, that blue line, meaning that we're risking too much. Okay, so I would like to continue working on that, move down to 205 and 200, and now notice the problem, which really we are not really improving this much more. Okay, um, we're going from 395 to 427. Give me a second, guys. I need to take a sip of water. Okay, so the risk has been still increased, even though the zone where we are in profit now is better. The orange line is there, so there is more profit here and also below. Okay, so I'm gonna try maybe one or two more cases, but I think I will stop it there, because the other thing I'm noticing, and that's why I use the word problem before I took a sip of water, is that because now we are going quite deep in the money. Okay, we are now hitting levels which are basically 205, 200 right there. So we are basically hitting levels which are more or less in line with what the probability cone is pointing at, meaning that this is quite far, and in this case it's far in the money. And because it's far in the money, we are now looking at possible problems of liquidity. Notice the bid price and the ask price, from 1780 to 1855. So this is now going to be more difficult for us to get filled with the proper value. Okay, so I'm going to try a couple more attempts to see how it goes. Again, I'm taking my sweet time with this one because it's really a good opportunity to learn multiple things. And then I'm going to move into, and I'm reading you, Mark. I love it because the one thing, as you can see, I've been just going for the fives and the zeros. Funnily enough, many times, even though the 0.5 strikes often have the reputation of less liquidity, there are times where they have, precisely because of less liquidity, they have more price anomaly. So you may get more benefits by using them. So I'm going to do that. And also I'm going to, in order to try to cut the risk, the other thing I'm going to try is to look at distances between the calls to be $2.5 instead of $5. Okay. So again, there is a lot of try that we need to do in this particular case. Okay. If we had more time left to expiration, then a normal butterfly would probably work very well, because you would still collect plenty of premium because expiration is far. March 4, it's relatively close. Okay, and that's the issue. So I'm going to move down one more time, 200 and 195. And yeah, I just got just a few more cents, and liquidity is more or less the same. So let's try one more time. 195, 190. Yeah, I'm kind of equalizing the risk here if I do those. But again, 27.5 to 28.15. I mean, it's not the worst in the world, but I'm not too happy. Okay, I'm gonna give it the last try, and then I'm gonna start moving into the 0.5s and other combinations to see what's the best solution we can find. Yeah, if I go one strike lower, it doesn't help at all. Liquidity now is $1 full of slippage on this one. Okay, so I'm gonna say that it's kind of like what I like the most from in the bottom part, if you wish, was 200 or above, something like that. Okay, so I'm gonna go ahead and buy the 202.5 and 200. Okay, and I'm gonna try this and then move higher and see what happens. So if I do that, okay, now of course, this is now an iron butterfly. Actually, it's an iron butterfly. It's a reverse iron condor, but it's actually a broken wing reverse iron condor. Notice how I got green on one side, but now, of course, I don't get green on the other side. But the good news is that my risk is almost equalized. Okay, so if I could push this a little higher, that may work. Okay, if you sell a new put, I mean, you are just adding more pain to the downside. You would need to protect that put with something, and therefore you're adding more risk, and the only way you will make money is that the stock goes higher. But if the stock keeps going lower, using puts, no matter if you use puts by themselves or you do spreads with the puts, it's going to hurt you more. So objective number one is to reduce risk. Using puts will add risk because you already got puts. Okay? So keep that in mind. So we're moving up. Okay? So 2052025. It's just a bit worse. 417. 205, 207 and a half, 432, 210, 207 and a half, 440. Again, we just need to find one strike with price anomaly built in. That's what we need, okay? So 212.5, 210. It's getting worse, okay? Mark, you were suggesting 207 and 212. So let me try that since I am using 212. So now I can easily change to 207, which is the one you were suggesting. And it's providing, it's kind of getting flat P&L. And on the bottom part, you are increasing your risk from 395 to 500. So it wouldn't work, okay? It wouldn't work. Yeah, so I'll try another time. So that would be 12.5. Yes, correct. And we are talking about 480. Again, it seems that all these prices have kind of normalized. We don't get any very specific advantage. Oh, look at that. Beautiful, perfect volatility smile now. We had price anomalies before, but not anymore, as you can see on FedEx. Well, this happens, my friends. So in this case, you gotta work with a little bit of patience, okay? And what I'll do is I want to execute the trade. I will keep the risk graph. We have a few minutes before the session is over. I want to look into another trade that we have as well, because there is something to be done on the other trade. So I'll keep this, and are we meeting tomorrow? No, oh, no, we are not meeting tomorrow. My bad. Okay, so guys, it would be good that you reproduce the exercise I've done later in the day, tomorrow. Again, good news. Again, no need for hope, first thing. Second, good news. You got UFOs in the chart. These may likely bring prices up a bit. The moment prices bring up a bit, many of the combinations I tried that didn't work for me will actually bring less risk and some green, okay, on the upper part of the risk graph. That would be the time for you to do the tweak, okay? Of course, if on top of that, I had, which I didn't, I had been doing rolls on the way down and collecting tiny amounts of credit every time, now I would have accepted some of those rolls, because some of those rolls that would have brought in equal risk or less and some of the green, I would have accepted it. The problem is that I didn't find any combination every time the orange line was below the blue line. The best it got, it was almost equalized, but it never got above the blue line, which is what I'm looking for. Reduce the risk and some of the green. So use patience, review it. At any moment in time, you may have a little bit of price anomaly in some of the strikes, and next thing you know, now you have a valid trade to improve the current P&L of this particular trade. Okay, so keep that in mind. I'm not going to do it because I didn't find it, but this will be the process for you to follow. So you may need to rewatch the video, you may need to repeat it. This is, believe me, a very, very good exercise and a very good time for you to do this, because it may really put you in a position, if you are not there yet, where now you really understand how to manage an Around Condor, and this is going to be very helpful for your future trades. Okay. Anyway, so I will leave this one here, and the other trade I want to discuss before we go is WPM. WPM, which is a trade which is working well. We took this trade as a double calendar. We tweaked it. We moved February 18 to February 25 on one side, to then February 25 in both of the sides. okay? We are currently with a P&L of around 34, and now the question is, okay, so what else do we do now? Okay, well, the idea is to go ahead and re-examine what's possible on this trade, because this trade is currently right here, okay? We are in the green, and if we keep rolling the February 25 expiration, things are going to get better, okay? So the question is it time to roll or not? And the way to know this is to look at current expiration and the next, okay? Current expiration and the next. This has an expiration date of March 11, okay? So up to March 11, we are good to go. We are looking at March 25 and March 4. And here what I'm going to do is I'm going to look at only 39 and the 44, which are the only two strikes I care about. So let's begin with the 44. The 44 is actually the at-the-money strike. Okay, it has a theta in the front wick of 32 cents. So 32 cents times 2 days. Okay, 32 cents times 2 days. This is around 60 something cents. We have up to 72 cents on the current value of this option. And in other words, even though we are very close to expiration, and normally we have distorted Greeks at this stage, because we are very close, we are 5 cents away from at the money. So there is still this slowdown effect on the time decay, and therefore that theta value is not distorted yet. So we are not going to touch on the call. Now on the put side, the delta value, the theta value is 14 cents. 14 cents times 2 days to expiration is 28 cents, where the ask price of the option is 6. So there's no way you're going to decay 28 cents if the most you can decay is 6. So those are distorted Greeks, and therefore the put side is to be rolled from February 25 to March 4. So let's grab the put side with WPM right here, and we're gonna create a rolling order from February 25 buy it to March 4 sell it. That is supposed to provide only 5 cents. How come? Wow, really no liquidity here. Really zero traded. Okay, zero traded. Well, in a case like this, obviously I wouldn't roll, because to roll for only 5 cents and pay commissions makes no sense. This is the effect of the stock has moved far. So let me close. So the stock has moved far up, okay? And because the stock has moved far up, we are far away from the 39, and therefore there is lack of liquidity here. So if you roll it, you get little. So how do you do it to suffer slippage because of lack of liquidity? Very simple. You wait until it expires, and first thing on Monday, or last thing before the market closes on Friday, even though that would have a margin impact, it would have a, depending on the funds in your account, you may get a margin call for that. So safe bet is on Monday. So let the 39 put that expires in February 25, right? Because we rolled it, it's 25. Let that one expire. Okay, I'm not sure what I've done with my text. I put it somewhere. Okay, okay, I messed up the text. No worries. So, oh yeah, it's here. Silly me. Yeah. I'm like, what did I do? So anyway, so the 39 put that expire in February 25. Let it expire, and then on Monday you sell a new one. Because if you let it expire all the way, and on Monday you sell a new one, then you're gonna collect new 16 cents of premium. Which collecting new 16 cents of premium is way more than getting 5 and pay commissions for that. So we are just going to leave the 39 alone. And the 44, okay, I need to talk about it because there is risk of assignment. And even though we have surpassed the time for the session to be concluded, I need to add a couple of comments here. So first of all, there is no reason to be concerned about the word assignment if you know what you're doing and you know what it is, because if you get a sign on the 44 call, okay, and this would only happen if on Friday the stock is trading above 44. So if the stock is trading above 44, the 25 February 44 call will expire in the money, and therefore you will be assigned and you will become short 100 shares on Monday. Well, actually on Friday or Saturday. So you'll have that on the account on Monday. That's what I mean to say. So the impact is buying power. That's the impact. Okay, the impact is buying power, but that's really not a big deal, because on Monday when the market opens, you're gonna close those shares and sell a new call. Okay? So can you be hurt in a bad way? No. Why? Because while you may be short, okay, I'm gonna substitute the 44 call by 100 shares short. Right? While you may be short 100 shares instead of a 44 call short, you also own a 44 call long. So if the stock goes up to infinity, you get hurt to infinity by being short shares, but you also make infinity with the 44 call. So the money you make on the call is being lost on the share, so you are flat. Okay? So you cannot lose more. But now what the thing could happen is that you could get lucky, which is you get a sign on the 44 call, right? On Monday, the stock is trading at whatever price, and then you have a movement down of the stock, or you have a gap down on the opening on Monday. And now the 100 shares you got assigned are giving you either less loss or more profit. And you close the shares and then you sell a new call using March 4. Okay. So the goal is, we had videos on that in the past. Okay. But again, for the ones of you that are newer to the sessions, the goal is, if you get assigned on the call and find yourself short 100 shares, okay, on Monday, you close the shares. Okay, so in other words, buy to cover. Okay, you get rid of the shares you were short, you buy them to cover. Okay, you close the shares and you sell a new March 4 expiration 44 call. That will give you a great amount of premium, given the fact that the price is very close to 44. Assuming that's the case on Monday, that will give you a great amount of premium. And we continue, and we'll talk more about the trade next week. Okay. Now, the other thing could happen is that the stock may fall before Friday. So if the stock falls before Friday, remember to watch for the theta values to get distorted. And if that is the case, then roll. Yeah, and you should be able to do that for a decent amount of premium, because you are close to 44. So then buying back the 44 call and selling a new 44 call using March 4 should pay you a fair amount. So you do it, so then you don't need to go through assignment. Okay, but don't do it before the Greeks are distorted. I mean, based on the rules, of course, you can do it anytime if that's your choice. But based on the rules I use in my own trading, so here, actually, I closed the option chain. Silly me. So again, one last time, speed of the light. If we look at, I'm just going to highlight the 44 call only, okay, because this is what we care about now. So when you look at the 44 call using March 4 and the 44 call using February 25, so again, you got 32 cents of theta, right, which times 2, okay, that is $64, which is more than 72. So the Greeks are not distorted yet. But the moment this number is less than, 2 times 32 or whatever theta is at that time, so then it's okay for you to move. Okay, and notice that if you were to do it now, you sell the 125, you buy back at 72, you just collected additional 70 cents of premium. Let's say you did it. If you did it, just so you know how it looks like. So if you did it, sorry, not option chain, not sure why I did that. Risk graph. So if you did it, right, this is how it would look like. So you buy back the 44 call that expires in February 25, and you sell a new 44 call that expires in March 4. Okay, so this is going to bring the current risk of the trade, which is 76. So the most you can lose is 76, right? So if you do this, now the most you can lose is 24, right? And now the graph is a bit weird, right? The graph is a bit weird because you still have the put, which is the 39 put, which is here. It's still using February 25. But the moment you roll the put 2, and let's say you collect 16 cents, so now your risk goes down from 24 to 24 minus 16, which is basically now you cannot lose, or almost you cannot lose. And now earnings are approaching, and implied volatility is rising, and this trade is looking very good to end up well. So hopefully you are following the rationale of what I'm saying. We need to conclude the session here. I surpassed it by 11 minutes, so it's time to conclude. But again, make sure that your risk of assignment is under control, not because assignment is something to be that scared about. If you don't know options, of course, be scared. But if you understand options, it's not a problem, especially because we have a long call, right? So not an issue, but you will have a margin impact because obviously being short shares is way more expensive than being short a call, especially if you are short a call against a call you buy. Okay, so keep that in mind. It's a temporary increase on the use of your capital because you get assigned on Friday. On Monday you undo it and you free up the capital, but you need to have that available capital in your account to be able to do it. If you don't have it, roll it now. That's it. Roll it now. Even though the Greeks are not distorted, roll it now. Okay, you know what, I'm gonna do it. You know what, no, I won't do it. I won't do it. Hopefully I get assigned. So next week I can show you how it looks like to be assigned, okay? But if you want to avoid assignment because you don't have enough capital or because you really don't like assignment, roll it now. The Greeks are not distorted yet, so you will leave a little bit of money on the table, but it's okay. It's not the end of the world, okay? So you can do that. What should we accept as a minimum premium? Whatever you are given. Whatever you are given. As long as it's more than what you pay for the commissions, which is why I'm not doing the roll on the put, because 5 cents and you pay more on commissions, right? These 4 contracts. So yeah, it doesn't make sense. As long as you get some net benefit, do it. Okay, that's it. Very good, my friends. Pleasure to spend some time with you. I will see you again on Sunday. We have a top session on Sunday, so hopefully I will see you all there. Hi to you as well if you're watching this recorded, and everybody, recorded or not, if you need us, message us, question page, anything. We're here to help you. Keep up the good work. Super happy to see some of the messages that you guys send and see how you put time and effort into everything that trading implies. So you become the trader you want to be. So keep up the good work, and thank you so much, guys, for being part of our community. See you soon. Bye bye.